class. We are now in the last video for our discussions on the past two, and this would revolve around a very important portion of the discussion, which would be inventory write down and the reversal of such inventory write down. The recognition of losses from inventory write down class and a gain from the reversal of the inventory write down is an application of the subsequent measurement rule for inventories. As already discussed in the past videos, inventories are to be measured, subsequently measured at the lower of cost and the net realizable value. And hopefully at this point, if you are watching this part of the discussion on inventories, you are already able to remember by heart that NRV is equal to your estimated selling price less cost of completion less cost to sell. Now, before going any further, I would like to emphasize that the goal for businesses class is to sell the inventories they have at a price higher than the cost in which they purchased the goods, at a price higher than the cost it took for them to manufacture or produce the goods. So the normal expectation class would be that the fair value or even the net realizable value of the inventories would be greater than their cost. But in the event class that the inventory is materially or significantly impaired, damaged, or becomes obsolete, as is in the case of technological products class, once a particular technology becomes obsolete, then definitely the value of your inventories using the old technology should go down. And connecting again our learnings from the conceptual framework class in which we observe conservatism, that we avoid any and all instances in which our assets will become overstated. It is a common theme class in the requirements provided by the standards that the amount reported for our assets should not exceed their recoverable amount, the amount that you will be able to recover if you are to sell or dispose the asset. Generally, we record a lot of assets based on their acquisition cost, but again, if ever class, due to some external factors, the recoverable amount of your assets, the NRV in the case of inventories, would be lower than the cost, then again, we will have to bring it down to its recoverable amount or again, its net realizable value. In the event class that the recoverable amount is lower than the carrying amount of the asset, we describe the asset in those cases as being impaired. There is an impairment on their values. So basically, class, the rule on subsequent measurement for inventories, which is LCNRV or lower of cost and net realizable value, is just an observance on the rule on impairment, wherein if ever the recoverable amount is lower than the cost, you abandon the cost, you do not report the asset at its cost anymore, but instead you bring down the carrying amount, you write down the asset to its recoverable amount. And basically, the NRV is just the equivalent of the recoverable amount for your inventories. So when we discuss property, plant, and equipment and other assets in the future class, the idea of impairment would be applicable to them as well. So I find it very important that as early as this stage, you would be able to understand already the concept of write down and the reversal on the write down. Problems on write downs class and reversals on the write down class would be a good source for tricky problems. Many students would not bother mastering the rule, especially on reversals class, and that is why a lot of students tend to arrive at the wrong answers for problems involving write downs or its reversals. Now, before going any further, I'd like to bring your attention to the simple explanation given by the standard as to why and when the recoverable amounts of the inventories would become lower than its cost. So as the standard states class, the cost of inventories may not be recoverable, meaning the whole cost may not be completely recoverable if those inventories are damaged, as I mentioned earlier, if they become wholly or partially obsolete, as what I also mentioned earlier, or if their selling prices have simply decline. So this statement class is very understandable. As we established earlier, the expectation of businesses is to be able to sell the inventories above the cost in which the inventories were acquired or manufactured. But again, it is entirely possible that the proceeds or the amount that you would get or recover from selling or disposing the inventories to the ultimate consumers would be lower than the cost. And again, the instances in which it can happen would be if the inventories are damaged or it becomes obsolete, or if simply the market price of such goods goes down. Now, for goods that are still in process, it is also possible that the cost may not be completely recoverable if the estimated cost of completion or even the estimated cost to sell will increase. There may come a point, class, in which your goods in process may no longer be a profitable prospect. It may happen that the entity will decide to no longer complete or finish the product because the entity anticipates or expects that by the time it completes or finishes the product, the total cost to bring it to its completion would be far greater than the amount that is expected to be recovered from its sale. So it's possible that even goods that are still in process may be considered impaired, may have to be written down. And in those instances, class, we will have to recognize a loss on inventory write down. It will result in a loss, class, understandably so, because you reported an asset at a certain amount, but you will have to report it at a lower amount. You originally recorded it at cost, but it turned out that the net realizable value is lower, then you will have to abandon the cost and again recognize it at its written down amount or at its net realizable value. And it results in a loss, class, because if you can remember our definition for a loss, losses, which are a subcomponent of expenses, are items that represent decreases in assets or increases in liabilities other than those representing contributions or withdrawals from our equity holders. So it should not be difficult to understand why it results in a loss. Again, it results in a loss because we are forced to reduce the amount previously recognized for our inventories. And this should not be very difficult to demonstrate, class. For example, the cost of your inventory was 150,000, and at the end of the reporting period, the net realizable value is 110,000. Then you will have to ask yourselves at what amount should you report your inventories in your statement of financial position. Should it be at the cost of 150 or at the net realizable value of 110? And again, applying the rule, class, of LCNRV, lower of cost and net realizable value, then you should report the inventory at 110,000. But based on your records, class, based on your trial balance from which our financial statements are based, the inventory was recorded at 150. But we know that the amount that should be reported in the financial statements in accordance with the PFRSS, in accordance with the standards, is that it should be reported at 110. So what do? You reduce your asset. As you should have learned already, class, transactions will always have dual impact on the elements of the financial statement. So if we are forced to reduce our asset, then we will have to recognize something else. And that something else would be our expense account, specifically our loss on inventory write down. Now, the rule appears very simple, class, because again, you will just have to choose the lower amount between the cost and the NRV. But why are there a lot of students who would get this wrong? Because, class, the problems will not always give you the net realizable value. The focus of the problem, class, is if you know whether to choose the cost or the NRV, and again, that should not be an issue. Simply choose the lower amount. But if that is the case, why are there a lot of students who will get this wrong? They would get it wrong, class, because the problem will not always give you directly the cost and the NRV. As to the cost, most of the times that would already be given in the problem. The information that problems would normally withhold would be with regard to your net realizable value. So that is why, class, I always emphasize it that it is very important for students to remember that your net realizable value is your estimated selling price minus your cost of completion minus your cost to sell.